Strong U.S. labor data, surging AI earnings, and rising oil prices are all hitting the tape at once, forcing equities to reconcile powerful growth with persistent inflation and policy risk. This is vTalkInsight, Equity Pulse Daily for June 4th, 2026, and we're breaking down what that collision means for the next leg of the equity market. U.S. macro data continue to come in hot, keeping the growth narrative firmly intact even as markets wobble. ADP reported private payroll gains of 122,000 in May, ahead of expectations, with hiring broad-based across education, health, trade, and transportation. That sits alongside resilient activity data, with services surveys in expansion and factory orders jumping nearly 5%, signaling demand is still running well above recessionary territory. The labor market remains tight enough to worry central banks. Job openings have pushed back toward two-year highs, layoffs are subdued, and wage growth is still elevated, around 4.4% for job stayers and about 6.5% for job changers. There is some moderation at the margin for movers, but not enough to convince policymakers that wage pressure, and by extension core services inflation, is fading quickly. Against that backdrop, the inflation story has stalled rather than resolved. Measures of services price pressure remain high, and inflation has been running above the Federal Reserve's 2% goal for more than 5 years, reinforcing the idea that it is embedded, not transitory. Market pricing now assigns more than a 70% chance to another Fed hike by year-end, with some commentators talking about policy rates needing to stay around 4 to 4.25%, while hopes of near-term cuts have largely disappeared. Higher for longer policy expectations are already feeding through into yields and correlations. Oil-driven inflation fears are pushing bond yields higher globally, and equities and bonds are increasingly moving together rather than offsetting each other, which weakens the classic 60-40 portfolio hedge. At the same time, broad indices remain calm on the surface. The S&P 500 has only just pulled back around 0.75% after a steady grind higher, and volatility gauges are still sitting near the mid-teens, masking significant single-stock dispersion underneath. This domestic story is framed by important currency dynamics. The US dollar remains fundamentally strong and is expected to stay elevated or even firm further, adding a headwind to non-US earnings translated back into dollars. In Japan, the central bank is seen as behind the curve, with entrenched inflation and negative real rates keeping the yen a preferred funding currency, even as officials flag a possible rate hike and hint at intervention near the 160 level, raising uncertainty for Japanese assets if policy credibility erodes further. Energy markets are amplifying these macro tensions. Renewed U.S.-Iran frictions, including attacks on shipping and infrastructure, have pushed Brent crude higher for a third straight session and left it hovering just below the $100 mark, with West Texas crude up about 3%. Inventories are drawing down at an unusually rapid pace. Diesel stocks in the U.S. are at their lowest since the early 2000s, and the risk of a prolonged disruption around the Strait of Hormuz is seen as underpriced, especially heading into peak demand season. Higher oil is not just an energy story. It feeds directly back into inflation and yields. Rising fuel and transport costs are reviving stagflation concerns, pushing bond yields higher and putting pressure on valuation multiples, particularly for energy-intensive and import-dependent sectors. Because inflation and growth shocks now tend to hit stocks and bonds together, the traditional diversification benefits of holding both have diminished, while cash yields near 4% offer a more palatable alternative to staying fully invested in risk assets. On top of energy, trade policy is becoming a more persistent macro overhang. The U.S. is considering new 10% tariffs under Section 301 and a separate regime targeting alleged forced labor, which could see 10 to 12.5% levies applied to goods from the European Union, the UK, China, Japan, Korea, and dozens of other partners. U.S.-China tensions are expected to remain structurally high, with retaliation from China seen as more likely than from other regions, and despite these pressures, most advanced chips are still manufactured in Taiwan, keeping semiconductor supply chains geographically concentrated and vulnerable. Set against this challenging macro backdrop is a remarkably powerful earnings engine centered on AI. S&P 500 earnings have surged about 28% year-on-year, with operating margins projected to reach a record 16%, and forecasts now point to earnings growth around 20% in 2026. Importantly, this is not just a technology story. Both tech and non-tech sectors are contributing to revenue and margin expansion, which helps explain why equities can trade near all-time highs even as rate expectations move higher. Semiconductors remain the focal point of the AI supercycle. The semiconductor index is up roughly 94% year-to-date and has helped drive the S&P 500 to its 24th record high of the year, as chipmakers benefit from an operating leverage boom that has lifted margins from around 30 to 45% in just 9 months. Hyperscalers are projected to spend about $700 billion on capital expenditure this year, and AI-related infrastructure investment in the U.S. has tripled over 2 years to roughly $750 billion, with expectations that total capex could approach $1 trillion in the not-too-distant future. Company-level signals reinforce that story. Broadcom's AI semiconductor revenue has jumped 143% year-on-year to $10.8 billion. It is expected to lift its 2027 AI revenue outlook to between $110 and $120 billion, and it has extended a strategic partnership with Google to support custom tensor processing units through 2031. Marvell stock has surged more than 30% as markets recognize its silicon as critical for high-speed data transfer between servers and data centers, while ASML has received a significant price target upgrade as analysts argue consensus undershoots the growth potential from AI-driven demand. Yet the same forces producing stellar earnings are also generating froth-like signals. High beta momentum stocks have rallied about 42% over the past 9 weeks, a move only seen during the late 1990s and early 2021 episodes that were followed by reversals, and speculative and profitable tech indices are up around 65% from March lows. The S&P tech sector is on track for its strongest 10-week performance since at least 1990. Technical measures like relative strength are stretched, and when tech has traded this far above its 200-day moving average in the past, even strong bull markets have seen drawdowns of up to 20%. Under the surface, the AI build-out also faces real-world constraints. AI token costs have roughly doubled in 6 months, prompting companies like Uber, Priceline, Walmart, Amazon, and Microsoft to tighten usage controls and focus more on cost discipline, with some management teams questioning the near-term payback from heavier AI spend. Data center developers are running into power and labor bottlenecks, with projected electricity shortfalls through 2028 and community pushback delaying or canceling more than $150 billion of planned U.S. projects, even as low-cost regions such as West Texas become new hubs, where on-site natural gas generation and existing long-haul fiber are used to bypass grid queues and support sub-10 millisecond latency for AI workloads. The flow picture is being reshaped by a new wave of equity issuance, led by SpaceX. SpaceX plans to raise $75 billion at a fixed price of $135 a share, implying a $1.75 trillion valuation and the largest U.S. IPO on record, despite revenue of only about $25 billion and net losses that nearly match sales. The free float at listing will be below 5% of the company's value. Around 30% of the deal is earmarked for retail investors, and there are no traditional anchor investors, setting up the possibility of sharp supply-demand imbalances, high volatility, and significant index effects as passive funds are eventually forced to add the name. SpaceX is not alone. A broader pipeline of high-profile AI-adjacent IPOs, including firms like Anthropic and OpenAI, is expected to come with very high implied option volatility, potentially near 100, reflecting deep uncertainty around lofty valuations. Index funds and benchmark-aware managers may have limited flexibility and feel compelled to own new mega-caps regardless of price, which could drive extreme price surges and further concentration, even as some houses warn that additional index weight for these listings will force selling of existing mega-caps to make room. That sits alongside a more general rise in IPO and secondary issuance, raising the question of whether incremental demand can fully absorb the new supply, despite estimates of roughly $250 trillion of global liquidity still looking for a home. In contrast to buoyant public equity issuance, private markets are flashing stress signals. Private credit funds are facing elevated redemption requests and have begun capping withdrawals, often at around 5% of assets per quarter, while a large European private markets fund recently gated after redemptions approached 10%, mainly from individual investors in Asia-Pacific. Partners Group has imposed limits on withdrawals from an evergreen private equity vehicle, and managers emphasize that while overall liquidity and credit facilities remain adequate, gating provisions are being used to protect remaining investors and preserve investment capacity, underscoring the structural liquidity mismatch when private strategies are offered in semi-liquid formats. Sector-level moves highlight how this complex backdrop is playing out on the screen. Defensive groups such as utilities, energy, and consumer staples have recently led gains, indicating a more risk-off tone even as indices hover near records, while leadership is simultaneously broadening into areas like transportation, aerospace and defense, healthcare, and parts of discretionary. Macy's has beaten earnings expectations, raised full-year guidance, and seen its shares climb, with management pointing to resilient demand from middle and higher-income shoppers, especially in its Bloomingdale's luxury segment, and Inditex has reported accelerating sales, strong margins, and benefits from nearshoring and premiumization, even as fading foreign exchange tailwinds temper future support. Other companies-specific developments flag pockets of pressure. Bernstein has downgraded General Mills on rising commodity costs, softer consumer demand, and limited pricing power, while AT&T faces a downgrade as analysts see satellite internet, particularly Starlink from SpaceX, emerging as a growing competitive threat to traditional broadband economics. In Europe, Akzo Nobel shares have dropped close to 20% after rejecting a joint cash offer from Nippon Paint and Sherwin-Williams and instead pursuing a merger with Axalta Coatings. A reminder that markets are quick to punish perceived missteps in capital allocation and M&A strategy, even in a broadly supportive equity environment. Putting it all together, equities are sitting at the intersection of robust, AI-powered earnings, resurgent inflation pressure from tight labor and higher oil, and a shifting policy and liquidity regime. On one side, strong S&P 500 profit growth, record margin projections, and a powerful semiconductor upcycle anchored by names like Broadcom, Marvell, and ASML continue to justify higher index levels and support the case that this is more than just a narrow tech story. On the other, rising odds of renewed Fed tightening, stubborn inflation, energy and trade shocks, stretched momentum, low option hedging, and record household equity exposure all point to a thinner margin for error, especially as mega IPOs like SpaceX alter supply-demand dynamics and private markets quietly manage liquidity stress. From here, the key signals to watch are the next rounds of labor and inflation data, the trajectory of oil and tariffs, guidance from AI heavyweights on capex, costs and power constraints, and how risk rotates between growth, defensives, and cash as yields stay elevated. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.